Today, we are going to learn 5 of the most important things the world's greatest investor of all time has to teach for us. And that, of course, is Warren Buffett. Now, just to understand exactly how impressive of an investor he was, all you have to know is that if you invested just $5,000 with him in 1965, today that would be worth over $275 million. In fact, if you invested just $20,000 with him originally, you would be a billionaire. And so Warren Buffett's investment record is so good that if he lost 99% of his money, he would still have beaten the S&P 500 over time. And so it would be supremely silly to not try to learn everything we can from such a phenomenal investor. And so today, we're going to look at 5 things that Warren Buffett has taught. Now, the first one we're going to talk about is this idea of price versus value. This is one of his most important teachings, and essentially comes down to the fact that you need to look at a stock as a business, not as just a piece of paper or an electronic number that just goes up and down for a variety of different reasons. In fact, investors make the most mistakes when they look at a stock and focus primarily on just the price. And then they try to estimate where the price is going, what the drivers of the stock price are, and they're totally missing the fact that the stock is really only there to represent the business. And so the first lesson from Warren Buffett is to focus on the business. If you analyze the business and understand whether or not it has strong competitive positioning, what its earnings power is over time, and whether or not its cash flows are going to continue to grow, and pay an appropriate price for that, eventually the stock price is going to follow those cash flows. And so that is the first lesson. And as he very succinctly puts it, price is what you pay, value is what you get. And so a good investor focuses on the value of the business. Number 2, margin of safety. Now, this is another really important idea. However, it really commonly gets misapplied. And that is because if you are an investor, you might have read Benjamin Graham's work where he talks about margin of safety as basically a 30% discount to whatever valuation you hold. And so Benjamin Graham, who for those that don't know is Warren Buffett's mentor, would do a valuation and then just haircut that valuation and often would refer to that as the margin of safety. Now, not that there's anything wrong with that per se, but it usually is not the best way to actually apply the margin of safety idea and is in fact not very likely how Warren Buffett himself applies the idea. Now, to understand what the margin of safety is, let us first paraphrase a quote that Warren Buffett has, where he says, if you're going to drive a 10,000-pound truck over a bridge, you're going to want to make sure that bridge is rated for more than 10,001 pounds. The idea there is that you're going to want some sort of cushion between the things that you need to happen and what can possibly happen in order for it to be a good investment. So when you are applying the margin of safety idea to an investment, there's many different ways you can actually do that in practice. Now, one of the most common ways, as I mentioned, is just taking a haircut to whatever valuation you capture at the end. This, frankly, is kind of the worst way, though, to apply the margin of safety. A better way is to just lower the assumptions you have in your sort of forecast for what a company is going to do in the future. And so if a company currently is growing, let's say 10% a year, and you're very confident that they're going to grow 8% a year, it would be very conservative to then say they're going to grow at least 5% a year. If you can make that assumption that they only need to grow 5% a year, and the investment still makes sense, that is how you are factoring in a margin of safety into your analysis. And so that is a way that when you are applying the margin of safety, you can actually understand what the assumptions are going into your investment instead of just haircutting it at the end. And very often investors actually do both, where they will be conservative on their assumptions and then also haircut the valuation at the end. Don't do that, because then you're going to complain that you can't find any businesses to invest in. And that is because you are doubling your layer of conservatism, which, okay, it's fine if you're aware that's what you're doing. But what you're basically doing is you're really hiring the bar to invest to a point that it's very unlikely you're going to find anything to invest in. And so the second lesson from Warren Buffett is margin of safety, which is again this idea that you are going to want some sort of cushion between what has to happen and what could happen in order for your investment to be satisfactory. Now, the third idea we are going to talk about is circle of competence. This is another really important idea that very commonly gets misapplied as well. And so the idea, generally speaking, is that you want to look at stocks and businesses that you understand pretty well. And so you don't want to invest in a biotech company that's in stage 2 trials, that's testing a very technical drug that requires understanding how protein synthesis works in a specific metabolic pathway in order for your investment to make sense. Unless, of course, you have a specialization in biotech, and that is exactly something you can answer with high confidence. Now, the reason why I say this idea gets misapplied very often is because people think that means you can only invest in simple businesses you understand. And in fact, Buffett pretty often also only invests in pretty simple businesses. He kind of traditionally has eschewed a lot of technology companies, and a lot of his portfolio is banks, retail companies, consumer products, a lot of kind of simpler businesses to understand. And so from that, people extrapolated that you shouldn't invest in technology companies or any company that requires learning something. That is not true, and that is not what he's saying. Now, when you think about the circle of competence, the correct way to understand this idea is that you only want to invest in businesses that you can eventually get to the point that you have high confidence in your assumptions. I'm going to say that again. High confidence in your assumptions. That is what the circle of competence is about. And so if you are looking at, let's say, NVIDIA, maybe you can do enough research, even if you never looked at semiconductors before, that you have a lot of confidence that they're going to continue to be the leader in GPUs and their CUDA programming language is going to continue to be used worldwide. That is something that maybe you can have high confidence in if you do enough research. It is also possible, however, that even if you are an expert in semiconductors, maybe you are a little unclear whether or not the hyperscalers, insourcing, or perhaps a separate semiconductor supply chain set up in China could eventually threaten the CUDA programming language. Maybe you're not so sure about what the future is going to hold. And so it's not that you don't understand the business and you don't understand what they do. It's just that you don't have high confidence in those assumptions. And so that is out of your circle of competence. Now, the reason why he invests in a lot of simple businesses is because those are businesses that are traditionally very easy to build high confidence in. If you have, let's say, a franchise model where every time you open up a store, it tends to do between 2 and 2.5 million in sales, then you could be pretty assured that the next store they're going to do is also going to open something similar. And so it's kind of easier to forecast that out. And as far as what the future holds, well, as long as people continue to like good tasting hamburgers at cheap prices, then you could be pretty sure that that business is going to be around. Whereas in contrast, we could go back to NVIDIA and say, what is the demand for GPUs going to be 20 years out in the future? Who's going to make them? Is there going to be some sort of other technological advancement that changes something in the semiconductor supply chain? So it's no longer TSMC that has the lead and they're no longer partnering with NVIDIA. What could the future hold? And so could something happen where NVIDIA is maybe not the leader in GPUs, or maybe GPUs aren't as important as a different semiconductor chip? These questions are things that are hard to answer without expertise in the area. And so that is what he means with a circle of competence. You want to stay in areas where you can answer questions with high confidence. Now, the fourth lesson from Buffett is one that you kind of have to pick up from his history of the businesses he's invested in. And that is that he is very much against debt. And that is because debt can put a company in peril of going bankrupt. If you have a business that generates money, generally speaking, it is almost impossible for them to go bankrupt unless you have a very prolonged period of competitive stress or something on the level of a depression. It's just very hard for a business to go bankrupt that is profitable unless they have debt. And so that is the reason why he has traditionally eschewed companies with even moderate loads of debt, but certainly nothing with a high load of debt. And that is because debt is an obligation to pay a party at some point in the future. And let's say you compound just a mild economic sort of recession with maybe a little bit of competitive pressures, and then a big maturity of debt coming due that the business has to pay out. even if they don't necessarily go bankrupt at that point, it could put them in a very weak position when they refinance, that the creditors take advantage of them in terms of very onerous credit covenants, or perhaps just very high interest rates, or maybe they also take warrants on the equity. The point, though, is that it makes your business much more fragile and less likely to withstand different sort of economic turmoil. And that is a problem because Warren Buffett likes to invest in businesses for the long term. And so debt, in short, just sort of compounds any sort of potential issue with the business. Now, many businesses may have profits fall during a recession, but if profits fall while you also have debt, then again, it just compounds that issue. And the equity holder is the one that can ultimately be hurt. And at the extreme, it could, of course, lead to bankruptcy. Again, it is very hard to go bankrupt if you don't have debt. Debt is like a weight around the business, and it really constricts their movement. And so Warren Buffett is traditionally have eschewed businesses that have high debt loads. And now this is also similar to another one of his ideas, which is going to be the last one we talk about, which is don't lose money. Now, this is his key finding. It is so important that he's actually said before, there's only 2 rules in investing. The first rule is don't lose money. And the last rule is don't forget the first rule. Now, this may seem a little bit coy. Okay, of course, when you're investing, you don't want to lose money, but what does that actually mean? Because doesn't every investment have some sort of risk of impairment of capital? Yes, that is true. And so how to think about this is when you are making an investment, you want to think about tail risk. Tail risk are these unlikely events that, if they do happen, can have an outsized impact on the business. And so maybe there's only a 1 in 50 chance that there's some sort of court ruling that makes a business's IP invalid. However, if that happens, then the business is basically done because then competitors can make that same sort of product and compete away all their profits. That would be a scenario where he would probably not be that interested in unless he had high confidence that the court would not rule against the company. And so that is what a tail risk in an investment is. And he does not like investments with tail risk. And so when he's saying don't lose money, that doesn't mean there's no possibility you'll never lose money on any investment. Of course, he has lost money on investments in the past. It just means that you want to avoid tail risk in investing, but also secondarily, you want to be aware that losing money is much more impactful to your portfolio than making money is. And the reason why that is because let's say you had $100, you lost 50%, now you're at $50. In order to get back to $100, you have to make 100%. And so it is much easier to lose money and much more negatively impactful to your portfolio than a positive gain is to your portfolio. And so a 50% loss hurts much more than a 50% gain is pleasurable. And funny enough, this is actually mirrored in psychology as well, where a lot of people are loss averse and find that losses hurt a lot more than gains are pleasurable. And that is a good thing, because if you want to invest like Warren Buffett, you want to avoid impairment of capital. And so just to recap, the 5 lessons to take away from the world's greatest investor of all time is focus on price, not value. Make sure your investments have a margin of safety. Focus within your circle of competence. Avoid companies with a lot of debt. And don't lose money. Look at those tail risk events and be loss averse. And these are just some high-level teachings from Warren Buffett, but there is so much more we can learn from him. And so if there's anything else in specific you're curious about, go ahead and drop a question in the comments below, and we can answer these from Warren Buffett's perspective in future videos. Thank you for listening, and if you like this content, please go ahead and hit like and subscribe.